Bill Gross went on to say that he's a more of a fan of the two-year Treasury or the Treasury inflation-protected securities or the TIPS. What's your take? Do you agree with him? Are you also a fan of the two-year? How do you see the bond market right now?
Well, I do think that there is some upward pressure, certainly on the 10-year point in the near term, and even on the two-year point. I think what we've seen is at the end of last year, the market is really pricing in a number of rate cuts and probably a little bit prematurely. So from our perspective, we're not expecting interest rate cuts to come as soon as March. And you're going to see continued resilience, at least for the time being, in the labour market and some other data. So that should put a little bit further upward pressure on yields in the near term. But then if you're looking out over a year as a whole, what we're anticipating is that at some point around the middle of this year, you will start to see interest rate cuts, not just in the Fed, but the ECB, the Bank of England, etc. And accompanied with that, there should be a bit of an economic slowdown. So both those factors should ultimately put some downward pressure on Treasury yields. It's just that this part of the year is going to be quite rocky and volatile.
You know, according to your most recent note, you also see a rally in the second half of the year after those Fed cuts. But in Q1, where we are right now, and also Q2, you see a lot of volatility. What's the catalyst for all this volatility in your mind? Of course, earnings season kicks off later this week.
Right. Well, I think at the end of last year, it was priced for perfection. There's very little chance for some any good news to continue or at least push this rally up another leg. So at the beginning of this year, what we're anticipating is a little bit more of a pushback against those rate cut expectations, which should add volatility. And also, as you get towards Q2, some evidence of an economic slowdown, which we do think investors will be a little bit concerned by. And that would add that volatility. But it's really important, as I said, that the investors try to look through some of that noise and recognize that typically, historically, once the Fed does start to reduce rates, provided it's not accompanied by a recession, you should see equities perform fairly well. And that also extends to some of the more cyclical parts of the market, such as small cap as well.
Yeah, you mentioned some more cyclical parts. I want to focus on the Magnificent Seven, some of those mega cap tech stocks that really pushed the rally last year. So we saw an announcement by NVIDIA. Basically, at-home AI gave that stock a boost, moved it to new record highs. Apple also has an announcement, or they'll be doing the pre-orders of their Vision Pro headset. How do you see these mega cap tech stocks shaping up in the first half of the year? Again, you believe there's a rally in the second half, but how do they influence the first half?
I mean, we can't exaggerate their importance to the market. We've just seen that from last year. Now, I'm not necessarily expecting much weakness. I do think earnings performance should be fairly good. The concern is that valuations are very, very extended. And investors now need to see proof in a lot of those numbers of their very, very elevated expectations. So again, I think that the Magnificent Seven may not see the same kind of rally that they saw in 2023. That is not to say that we're anticipating a significant pullback. It's just that it probably won't match the kind of gains that we saw last year.